Right now, on this Friday the 24th of July, 2026, the euro is slipping against the US dollar, and the reason is a single economic data release out of the United States. Flash Purchasing Managers Index data came in stronger than expected today, triggering an immediate rally in the greenback across the board. Euro to US dollar fell sharply in the hours following the release, and the move has sparked fresh debate about the divergence between the American and European economies. If you hold euro-denominated savings, trade currency markets, or are planning a trip to the United States anytime soon, this move directly affects your purchasing power. In the next few minutes, we are going to break down exactly why this happened, who is feeling the pressure, and crucially, whether the euro has found a floor or whether further losses are on the way. Before we can understand why today's data moved markets so powerfully, we need to understand what PMI actually measures. The Purchasing Managers Index is a monthly survey of business decision-makers across the manufacturing and services sectors. Respondents are asked whether conditions have improved, worsened, or stayed the same compared with the previous month. A composite reading above 50 indicates expansion in economic activity, below 50 signals contraction. The reason currency traders pay such close attention to PMI is that it is a leading indicator, meaning it tells us where the economy is headed before the official figures are confirmed. When US PMI beats forecasts, it signals a stronger American economy, reduces the likelihood of Federal Reserve interest rate cuts, and makes dollar-denominated assets more attractive to global investors. That is the chain reaction that triggered today's euro to US dollar sell-off. Today's flash PMI reading from the United States was the catalyst for everything you are seeing in the currency market this afternoon. Both the manufacturing component and the services component of the index came in ahead of analyst expectations, painting a picture of an American economy that continues to grow with real momentum. Markets had been priced for a more modest reading, and the beat caught many traders off guard. The dollar's reaction was immediate and broad, with gains recorded not just against the euro but also against the Canadian dollar, which came under particular pressure according to multiple financial outlets reporting today. For euro to US dollar specifically, the pair pulled back sharply from where it had been trading earlier in the session, reflecting a swift repricing of US interest rate expectations in response to the stronger-than-forecast data. Despite the pressure on the euro today, it is important to understand why the sell-off has not been more severe. Analysts at BBH, one of the leading currency research houses, noted this afternoon that hawkish signals from the European Central Bank are acting as a meaningful cushion beneath the single currency. The ECB has been signaling that it is in no rush to cut rates further, given that inflation in the Eurozone has remained stickier than initially projected. On top of that, Eurozone PMI data has shown genuine resilience in recent months, suggesting that the European economy is not in as fragile a position as some had feared. These two factors, an ECB that is holding firm on rates and an economy that continues to expand, are providing just enough fundamental support to prevent a deeper euro to US dollar decline today. The impact of today's strong US PMI data has not been limited to euro to US dollar. Across the foreign exchange market, the greenback has strengthened against a broad basket of currencies, reflecting a repricing of global interest rate expectations in real time. The Canadian dollar has been one of the notable casualties today, under sustained pressure as investors reassessed the outlook for the Bank of Canada relative to a Federal Reserve now seen as less likely to cut rates aggressively. The British pound has also faced headwinds from dollar strength in recent weeks, a pattern that has continued to define the pound sterling to US dollar pair through much of 2026. What today's moves confirm is that when US economic data surprises to the upside, the dollar rally tends to be indiscriminate, sweeping up every major currency pair in its wake. So what does all of this mean for ordinary people managing their finances? For British and European travelers planning holidays to the United States, a stronger dollar means your money goes less far when you arrive. If you exchanged currency earlier this month before today's PMI print, you are in a better position than those who wait. For UK exporters selling goods and services to American clients, dollar strength can be a genuine tailwind, making British products relatively cheaper in US dollar terms and boosting competitiveness. For property owners and businesses carrying euro-denominated borrowing, the ECB's reluctance to cut rates quickly means financing costs are likely to remain elevated for longer. And for investors holding European equities, a strong dollar often signals a shift in global risk sentiment that can weigh on European stock markets through indirect channels. It is worth putting today's move in historical context. Dollar rallies driven by strong U.S. economic data have been a recurring theme throughout 2025 and into 2026. Each time the Federal Reserve has signaled that rate cuts are further away than markets had hoped, the dollar has surged, and euro to US dollar has come under renewed pressure. What makes today's episode particularly notable is the contrast between a robust US PMI print and a eurozone that, while resilient, continues to grow at a more modest pace. This growth divergence between the two economic blocs has been the dominant narrative in the euro to US dollar pair for an extended period. Understanding that pattern helps traders and investors avoid being caught off guard each time a strong US data release triggers the familiar greenback rally that we are witnessing right now. Looking ahead into the sessions that follow today's data release, the near-term direction of euro to US dollar will depend on two principal forces. First, any additional U.S. economic data that continues to beat expectations will reinforce dollar strength and put further pressure on the euro. The Federal Reserve's next communications will be watched particularly carefully for any shift in the rate outlook. Second, the ECB's policy trajectory will be crucial. If the bank signals further hawkishness at its next meeting, or if Eurozone economic data continues to surprise to the upside, the euro could find renewed support and claw back some of today's losses. Most currency analysts today are suggesting a cautious, range-bound outlook for euro to US dollar in the near term, with the pair unlikely to move dramatically in either direction unless a significant data surprise or central bank pivot breaks the current equilibrium. The key takeaway from today is this: currency markets respond instantly to economic data, and the U.S. Purchasing Managers Index has once again demonstrated its power to move the greenback. On Friday, the 24th of July, 2026, stronger than expected US PMI has pushed the euro lower, fueled a broad dollar rally, and squeezed currencies from the Canadian dollar to the British pound. At the same time, a hawkish ECB and resilient Eurozone economic data are preventing the kind of collapse in the euro that a weaker fundamental picture might have triggered. If you are watching currency markets, managing overseas finances, or trading Forex, today's session is a reminder of how quickly the landscape can shift when the data catches markets off guard. Stay informed, stay agile, and we will see you in the next video.